Does Medicare pay for in-home care? And the answer to that is it depends on what you mean by in-home care. So if you're referring to in-home health care, yes, Medicare will typically pay for that if you're unable to leave your home, and it really only covers medical services. So doctor visits, nursing care visits, physical therapy, your medical equipment, etc. What Medicare will not cover is 24-hour care, meal delivery, homemaker services, so cooking, cleaning, companionship, or custodial care. So if somebody needed help with bathing, dressing, using the bathroom, etc., Medicare is not going to cover that. Now, in-home care, assuming that it's not covered by Medicare, is expensive. So according to Genworth, you're looking at $5,600 for a home health aide at 44 hours a week, or $21,000 a month for 24-hour care. So again, in-home care can be really, really expensive, which then leads us to the question of how are you going to pay for it? So again, like I just mentioned, Medicare is typically only going to cover in-home health care. That's medically necessary. And then there are limitations to what it pays. It will not pay for custodial care. So, the homemaker services, helping, getting dressed, going to the bathroom, eating, etc. So your family, they might be able to help pay. Depends on their financial situation. Or they may be able to help you out just from a time standpoint. Maybe somebody moves in with you. So there are other ways that family could help. Medicaid, you may or may not qualify. It depends on where you live. It also depends on your income and asset levels. And the other thing to consider about or think about or know, because I don't think a lot of people know this, but is Medicaid does have the ability to lien the estate. So after the last spouse is passed, Medicaid can lien the estate in order to try and recover some or all of the costs that they've paid towards your in-home care. So where most people are going to gravitate is towards their retirement savings. And the issue is that if you're spending all of your money on in-home care, is you could completely wipe out any retirement savings that you have. And then on top of that, if a spouse passes away, then we also have lost household income. So in general, spending all your money towards in-home care could put you into the remaining spouse into a financial bind. And then, of course, there's income tax obligations from drawing out large sums of money to pay for in-home care. So the good news is there is an alternative way to pay for in-home care, and that is to pay for in-home care with a reverse mortgage. And there's several reasons to consider this. First and foremost is it could provide access to an additional source of funds of income tax-free cash to help pay for in-home care. On top of that, it could help retain retirement savings. So instead of spending all the money on all retirement savings on in-home care, maybe you spend the proceeds from the reverse mortgage first to try and retain those retirement savings. You may not need any financial assistance from family at all. Or maybe it's at a reduced amount that they can actually afford. And then finally, you have the ability to potentially leave a spouse and the remaining spouse with additional funds to supplement their income. So again, if you don't spend all your money in retirement all your retirement savings, or spend all the money from the reverse mortgage, it could leave the spouse in a position to be able to supplement their income with what's left over. So let's take a look at the scenario of Luke and Amanda. They're both 81, $3,500 a month of income. They own their home free and clear, and they have about $75,000 in retirement savings. So both Luke and Amanda need someone at home to help them with daily living tasks, and they are being stubborn, which, it's totally their choice, but they do not want to move into assisted living. And the good news is their daughter lives with them and helps take care of them. But the issue is their daughter still works full time, and they need somebody in the home to help them while their daughter is at work. So the issue is that in-home care is going to be $5,000 a month for 40 hours a week of care. And after tax, they've really only got enough money to pay for about a year's worth of care. And then regardless of who passes first, they're going to lose about $1,500 a month of income. So Luke and Amanda's daughter reached out to me to see if the reverse mortgage would be an option for them. So came up with a couple different options. The first one is to use the retirement proceeds first to pay for in-home care. And remember, they would be able to pay for about a year. And then on the second year, after they've spent all their retirement savings, they would start drawing out $5,000 a month to pay for care. And they'd have about 4 years of funds available to pay for that care. So they'd get about 5 years of care between their current retirement savings and the reverse mortgage. So that scenario is represented by this bar chart here. The blue represents the home value, assuming a 4% appreciation rate. The orange represents the loan balance, and you can see initially we're starting off with a $19,000 loan balance because we're lumping in the closing costs. And this loan balance is growing over time, and that's happening for two reasons. One, starting in year 2, they're going to be drawing out $5,000 a month, $60,000 a year to pay for their in-home care. And 2, we are making the assumption that they are not going to make a monthly mortgage payment towards the reverse mortgage. And because of that, the taxes and insurance get lumped into or get added to the loan balance. But they do still have to pay their property taxes and their homeowner's insurance as well. The green, we can see initially we're starting off with a $211,000 line of credit, and we can see this drops down significantly over that time frame because, again, we're drawing out $60,000 a year to pay for in-home care. Option 2 is to get a reverse mortgage to supplement their income when one spouse dies. And so they would draw $1,500 a month for 10 years after the first year. They could draw further, but in 10 years, they're going to be 91 years old. And after they've spent their retirement savings, they could go on Medicaid. And that, again, assuming that it's available to them and that they qualify. But what's great about this option is that this line of credit is basically the same amount all across here over this 10-year period, even though the remaining spouse is drawing out about $18,000 a year, which seems crazy. But the reason that's happening is because any funds that are available in that line of credit are growing at the current interest rate plus 0.5%. So really what we're doing is they are just pulling out the growth in that line of credit and hardly even reducing the what's available in that line of credit. Now, I will tell you that drawing money out of the reverse mortgage and putting it into a checking or savings account could pose an issue with Medicaid, and I would highly recommend speaking with a Medicaid specialist on what needs to be done there, because there are some other strategies, but you do need to talk to somebody that is a Medicaid specialist so that you don't lose your ability to qualify for Medicaid. But this is another option for them to consider. So as you just saw in those examples, there are some pretty good reasons to consider getting the reverse mortgage to help pay for in-home care. First and foremost is it provides the ability to do better planning around care needs and finances. And that's because we are providing flexibility on where funds can come from to pay for care. So if you only have retirement savings, there's really not much planning there. You're just going to spend that money until it's gone. But by introducing another source of funds, we now have two different places that we could draw from to pay for in-home care. And that's where other professionals could come in to help determine what is the optimal way and what is the optimal place to draw funds from to pay for that care. So you can bring in a financial planner, a CPA, maybe an estate planning attorney to really figure out, does it make more sense to do it this way or that way or whatever. The other thing that's great is that we are providing access to additional funds that could create financial stability for the remaining spouse. And the reason for that is typically once a spouse has been lost, household income is lost, and so the reverse mortgage could help supplement their income and also provide them additional source of funds to pay for other financial shocks that may pop up, whether that's medical expenses, they have their own long-term care or in-home care needs, uh, home maintenance, all of those things can be financially devastating. And now we've introduced another source of funds. And then finally, it creates peace of mind. And that's knowing that both spouses are aware that the remaining spouse should be in a much better financial position once the other spouse has passed away. And also knowing that they have another source of funds. So if retirement proceeds are spent, there's another source of funds to continue the in-home care that is needed. So lots of reasons to consider getting the reverse mortgage to help pay for your in-home care. Want to see if this would work for you? Want to see what your numbers would look like? You want me to do some forecasting, run some different scenarios? I'm happy to do that. There's no cost to speak with me. There's no cost for me to do any of those services I just suggested. There's no cost for me to put numbers together for you. Give me a call. I'm happy to speak with you, happy to help answer any questions that you have about the reverse mortgage. I look forward to speaking with you. Thanks.